EPK Capital presents Daily Brief, 23rd of August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host Alan. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So without further ado, let's begin. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. The story of the last 24 hours is a tale of a market holding its breath and then exhaling in a spectacular, record-shattering roar of relief. Before today's session, Wall Street was gripped by a palpable sense of anxiety. The benchmark S&P 500 index had just posted its first 5-day losing streak since January, a slow bleed of uncertainty that saw investors methodically reduce risk ahead of one of the most anticipated events of the year. Federal Reserve Chair Jerome Powell's annual address from the Jackson Hole Economic Policy Symposium. This cautious positioning was not driven by a sudden downturn in economic data, but by the fear of what the world's most powerful central banker might say about inflation and the future path of interest rates. Then, at 10 a.m. Eastern Time, the script was flipped. In a matter of minutes, a market coiled with tension sprung into a powerful rally. The cautious, risk-off sentiment that had defined the entire week evaporated, replaced by a wave of buying that can only be described as euphoric. By the time the closing bell rang, the week's losses were a distant memory, and new, all-time highs had been forged. The final numbers for Friday, August 22nd, 2025, tell the story of this dramatic reversal. The Dow Jones Industrial Average surged an incredible 844.61 points, or 1.89%, to close at a new record high of 45,628.12. The S&P 500 jumped 98.38 points, or 1.54%, to finish the day at 6,468.30, also a new closing record. The tech-heavy Nasdaq Composite was the day's top performer among the major indices, soaring by approximately 2%, or over 420 points, to hit an intraday high of 21,523.23. This was not the behavior of a market grappling with fundamental weakness. Rather, it was the action of a market that had been tactically de-risked, with a massive amount of capital sitting on the sidelines, waiting for a clear signal. The 5-day decline was a hedge against a hawkish outcome, and the velocity of the subsequent rally reveals an underlying bullish bias, conditioned to respond aggressively to any hint of dovishness from the Federal Reserve. The day's events underscore a crucial reality of modern markets. The anticipation of monetary policy and the narrative shaped by central bankers can be a more powerful short-term driver of asset prices than the economic data itself. Global Market Dashboard, a tale of two sessions. Zooming out to the global picture, the trading day on August 22nd was clearly bisected into a before Powell and after Powell world. The Asian and early European sessions were driven by a diverse set of local catalysts, but once the message from Jackson Hole was delivered, it became the only narrative that mattered, subsuming all other factors and forcing global markets into alignment. In Asia, the pre-Powell session was a mixed and cautious affair. In Japan, the Nikkei 225 ended the day nearly flat, inching up just 0.05% to close at 42,633.29.9. The market was grappling with its own domestic concerns after July's core inflation data came in hotter than expected, fueling speculation that the Bank of Japan might be forced to consider a rate hike of its own. Conversely, mainland Chinese markets showed significant strength. The Shanghai Composite rallied 1.45% to close at 3,825.76. This move was fueled in part by tech sector optimism, driven by reports that US chip giant Nvidia might be halting production of its H20 AI chip for China, a development seen as a potential opening for domestic competitors. Hong Kong's Hang Seng Index also had a positive session, rising 0.8% to finish at 25,317-15. Meanwhile, in India, the market's recent momentum came to a halt. After a 6-day winning streak, the Nifty 50 index fell 0.85% to 24,170 as traders took profits off the table ahead of the uncertainty surrounding the Jackson Hole event. European markets opened with a similarly muted and cautious tone, with the broad Euro Stoxx 50 index down 0.2% in early trading. However, as the day progressed and the dovish signals from the US rippled across the Atlantic, sentiment improved markedly. Germany's DAX finished the day with a solid gain of 0.32%. The most telling reaction came from London, where the FTSE 100 rallied into the close, gaining 0.13% on the day to finish at a new record high of 9,321.40. This marked the index's fourth consecutive record-setting session, with the final push explicitly linked to the relief rally sparked by Powell's speech. The following table provides a snapshot of the day's performance across these key global indices, visually capturing the divergence in Asia and the powerful unified rally that took hold in the West. The day's trading action provides a powerful illustration of the US Federal Reserve's immense influence on global capital flows. While regional markets began the day trading on their own distinct fundamentals, Japanese inflation, Chinese tech news, Indian profit-taking, the moment the Fed's policy signal was released, those local narratives were rendered secondary. The world's markets began to trade as a single, highly correlated block, all responding to the same stimulus, the changing expectation for the price of the world's reserve currency. This demonstrates that in the current environment, the gravitational pull of the Fed can override and subordinate all other market drivers, making a correct call on US monetary policy more critical for global investors than a correct call on their own local economies. The Jackson Hole, decoded inside Jerome Powell's landmark speech. To understand the violent market reaction, we must dissect the language of Jerome Powell's speech. It was a masterclass in central bank communication, carefully constructed to deliver a dovish message that the market was desperate to hear, while simultaneously acknowledging contradictory data and preserving the Fed's future flexibility. The key money quote, the line that instantly triggered buy orders across Wall Street, was Powell's clear signal of a dovish pivot. He stated, "With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance." For a market that had been pricing in the risk of a hawkish hold, this was the green light it needed. But how did Powell justify this potential shift, especially in the face of recent data showing strong growth and rising inflation? He did so by executing a brilliant narrative pivot. Instead of focusing on the present, he directed the market's attention to the future. The justification was built not on current weakness, but on future risks, specifically within the labor market. He described the current jobs picture as a curious kind of balance that resulted from a marked slowing in both the supply of and demand for workers. He then delivered his core argument, warning that downside risks to employment are rising, and if those risks materialize, they can do so quickly. This framing was crucial, as it allowed him to build a case for preemptive easing to guard against a future problem. Having established this new focal point, he then addressed the elephant in the room, inflation. He directly acknowledged the impact of the Trump administration's tariffs, conceding that their effects on consumer prices are now clearly visible. This gave his speech credibility. However, he immediately downplayed their significance for monetary policy, suggesting that a reasonable case is the effects will be relatively short-lived, a one-time shift in the price level, rather than a persistent inflationary problem. This was a deliberate and highly effective communication strategy. The market's primary fear was that the strong PMI data released just a day earlier would force Powell to take a hard line on inflation. By first acknowledging the price pressures, but then reframing them as a secondary, one-time issue, he neutralized that fear. He then elevated the more abstract, forward-looking risk of an employment downturn to the primary concern. This skillful maneuver created a new, compelling justification for a rate cut that was based on risk management rather than backward-looking data, giving the Federal Open Market Committee the intellectual and political room it needs to potentially cut rates at its September meeting. The bull unleashed, anatomy of a market rally. The market's response to Powell's dovish narrative was immediate and broad-based, but the rally was not indiscriminate. The biggest winners were the very sectors and asset classes that are most sensitive to interest rate expectations, and that had been under the most pressure during the week's sell-off. The charge was led by the long-duration growth sectors, particularly technology and semiconductors. Having slumped for much of the week, these stocks reversed course with stunning speed. The PHLX Semiconductor Index, SOX, jumped about 3%. Shares of Tesla, TSLA, soared 6%, while tech titans Alphabet, Google, and Amazon, AMZN, both gained more than 3%. Chip designer Nvidia, NVDA, rose around 2%. The rally in rate-sensitive assets was also evident in the housing sector, where stocks posted big gains on the prospect of lower mortgage rates and borrowing costs. Within this broad rally, however, company-specific stories created massive performance divergences. Intel, INTC, was a standout performer, surging 7%. Its rally was amplified by a stunning announcement from President Donald Trump, who said the US government had agreed to take a 10% equity stake in the beleaguered chipmaker, potentially converting grants from the CHIPS Act into direct ownership. Nvidia, NVDA, shares climbed despite a complex news backdrop. The stock had been under pressure from reports that it was halting production of its H20 AI chip for China. However, CEO Jensen Huang clarified that the company is in active dialogue with the US government about a potential new, more advanced chip for the Chinese market, the B30A, which would be a follow-up to the recently reapproved H20. This news suggested a continued, albeit complicated, path for growth in a key market. On the other end of the spectrum, the day's macro tailwind was not enough to save companies that delivered bad news. Intuit, the maker of TurboTax, was the worst performing stock in the S&P 500. Its shares plunged 7.59% after the company issued a disappointing financial outlook, proving that even on a day of widespread euphoria, poor fundamentals can be brutally punished. Similarly, enterprise software company Workday, WDY, also missed the party, falling around 4.5% after its own weak guidance disappointed investors. The sector-level performance clearly illustrates the risk-on rotation that took place, with capital flowing decisively out of defensive areas and into growth-oriented and economically sensitive parts of the market. The day's trading action reveals a bifurcated market. A single macro event, Powell's speech, determined the overall direction of the market, the beta. However, beneath the surface, company-specific fundamentals created enormous winners and losers, the alpha. The fact that Intel could surge 7% on government-related news while Intuit plunged over 7% on its earnings report, all on the same day, highlights that even in a market overwhelmingly driven by central bank policy, fundamental analysis and stock selection remain critically important. The political dimension, the Fed under fire. The economic drama of Powell's speech played out against a backdrop of intense and unprecedented political pressure. For months, President Donald Trump has engaged in a public campaign to influence the Federal Reserve, repeatedly criticizing Chair Powell and demanding immediate interest rate cuts to boost the economy and lower government debt servicing costs. On Friday, this pressure campaign escalated dramatically. As Jerome Powell was delivering his carefully crafted speech in Wyoming, President Trump told reporters in Washington that he would fire Federal Reserve Governor Lisa Cook if she did not resign. This threat was based on unconfirmed allegations of mortgage fraud leveled by a Trump administration official. This move is widely seen as an attempt to create a vacancy on the Fed's powerful Board of Governors, which the president could then fill with a nominee more aligned with his policy preferences, further eroding the central bank's long-standing independence from day-to-day politics. In a different market environment, such a direct challenge to the integrity of a core financial institution might have triggered a crisis of confidence, sending stocks tumbling. Yet, the market's reaction was the complete opposite. There is no evidence that traders were spooked by this political hardball. Instead, they focused exclusively on the dovish message being delivered by Powell and bought stocks with both hands. This reveals a significant psychological shift in how the market processes political risk. It appears that traders have become so desensitized to the political noise that they now largely discount it, at least in the short term. The abstract, long-term danger of institutional erosion is being completely overshadowed by the tangible, immediate promise of cheaper money. The market is no longer pricing in the risk of political interference. It is celebrating the potential outcome of that interference, easier monetary policy. While this sets a potentially dangerous long-term precedent, for today's traders, the path of least resistance was to simply follow the liquidity. The bigger picture. Key macro and trade developments. The Federal Reserve's policy deliberations are not happening in a vacuum. They are set against a complex backdrop of new trade policies and conflicting economic data, which makes Powell's dovish signal all the more remarkable. Just one day before the speech, two significant pieces of information emerged that would typically argue for a more hawkish, not dovish, monetary policy stance. First, the United States and the European Union announced the framework for a major new trade agreement. While providing much-needed clarity, the deal comes at a cost. The US will impose a new blanket 15% tariff on the majority of EU exports, including automobiles and pharmaceuticals. In exchange, the EU will eliminate its tariffs on US industrial goods and grant wider market access for some American agricultural and seafood products. The framework also includes significant, though non-binding commitments for the EU to purchase $750 billion in US energy and for European companies to invest $600 billion in the US economy. This new tariff structure represents a direct, fresh inflationary impulse for the US economy. Second, the latest Flash Purchasing Managers Index, PMI, data for August painted a picture of an economy with strengthening growth and accelerating inflation. In the United States, the S&P Global Composite PMI rose to an 8-month high of 55.4, indicating robust expansion. The manufacturing sector rebounded sharply, moving from contractionary territory in July to a strong reading of 53.3. Most critically for the Fed, the report noted that companies were passing on tariff-related costs, leading to the steepest increase in average selling prices in 3 years. The story was similar in the Eurozone, where the HTOB composite PMI climbed to a 15-month high of 51.1. The manufacturing sector there moved into expansion for the first time in over 3 years, and inflationary pressures also intensified across the bloc. This combination of factors, a new broad-based tariff regime and PMI data showing accelerating growth and rising prices, creates a classic recipe for monetary tightening. A central bank facing these conditions would normally be expected to hold rates steady, or even consider raising them to head off inflation. The Fed's decision to instead signal a potential easing of policy represents a major and fascinating contradiction. This suggests the central bank is engaged in a high-stakes gamble. It is choosing to look through clear and present inflationary signals, betting that they will prove transitory. The Fed's focus on the downside risks to employment indicates it is deeply concerned about a potential Wile E. Coyote moment, where the labor market suddenly falls off a cliff. By prioritizing this future, potential risk over the current, observable data on inflation, the Fed is taking a calculated risk. If it is wrong and inflation proves to be more persistent than anticipated, the central bank could find itself severely behind the curve, potentially requiring more aggressive and market-disrupting rate hikes in the future. Crypto surges, digital assets, ride the risk-on wave. The wave of optimism unleashed by Jerome Powell's speech was not confined to the stock market. The cryptocurrency space, which had been trading cautiously, surged in lockstep with equities, demonstrating its current function as a high-beta, leveraged play on global liquidity. The price action was a mirror image of traditional risk assets. Before the speech, Bitcoin, BTC, was languishing, having dipped to a low near $112,000. After Powell's remarks, it ignited a powerful rally, surging past $117,000. Ethereum, ETH, saw an even more dramatic move, jumping by as much as 7.5% to reclaim the $4,600 level. This risk-on sentiment also lifted crypto-related equities, with shares of the exchange Coinbase, Coin, and major corporate Bitcoin holder MicroStrategy, MSTR, both gaining more than 6%. What makes this rally particularly telling is the news that the market chose to ignore. On the very same day, Interpol announced the results of Operation Serengeti 2.0, a major international law enforcement action. A key highlight was the dismantling of a massive cryptocurrency investment fraud scheme based in Zambia. The sophisticated operation had ensnared 65,000 victims worldwide, with estimated losses totaling an astonishing $300 million. The crackdown led to the arrest of 15 individuals and the seizure of critical infrastructure. In a mature, fundamentally driven market, a headline of this magnitude, highlighting the persistent and large-scale risks of fraud within the ecosystem, would likely temper enthusiasm or cause at least a temporary dip in prices. The crypto market, however, completely disregarded it. The only news that mattered was the macro signal from the Fed. This behavior reveals that, for now, the valuation of digital assets is being driven less by fundamentals like adoption, utility, or security, and more by its role as a primary destination for speculative capital when monetary conditions are expected to loosen. The market's blindness to the significant Interpol bust is a clear indicator of its current speculative nature, where the tide of cheap money is powerful enough to lift all boats, regardless of their structural integrity. Elsewhere in the crypto space, the regulatory environment continues to evolve. A report indicated that Asset Manager Shares had launched an XRP-based exchange-traded fund, ETF, in Delaware, a positive sign for product adoption. This comes just days after reports that the SEC had delayed its decision on several proposed XRP ETFs, including one from 21 Shares, highlighting the complex and often contradictory regulatory landscape. Additionally, the Commodity Futures Trading Commission, CFTC, is reportedly moving forward with crypto initiatives designed to align with the Trump administration's recommendations, signaling continued engagement from US regulators. Final thoughts: the path forward. The story of August 22, 2025 will be remembered as the day a single speech shifted the entire global market landscape. It was a day that laid bare the immense power of central bank guidance, demonstrating how a few carefully chosen words could erase a week of losses and propel major indices to new all-time highs. It showcased a market willing to look past significant political risks and contradictory economic data in its singular pursuit of easier monetary policy. And it confirmed the tight correlation of all risk assets, from semiconductor stocks to Bitcoin, in an environment overwhelmingly driven by liquidity expectations. The path forward is now set on a fascinating and potentially volatile course. The market has moved aggressively to price in a rate cut at the Federal Reserve's September meeting, with futures markets now implying an 87% to 89% probability of such a move. This creates a high-stakes scenario for the coming weeks. The market's dovish narrative is now pitted directly against the incoming economic data. The next US jobs report and the upcoming Consumer Price Index, CPI, and Producer Price Index, PPI, inflation reports will be scrutinized with an intensity rarely seen. If the employment data comes in strong and inflation remains stubbornly high, it will directly contradict the very foundation of Powell's justification for a cut. Such an outcome could force the Fed to walk back its dovish tilt, potentially triggering a sharp and painful market correction as traders are forced to unwind their bets on imminent easing. The central tension for the market is now clear. Investors are betting on a soft landing, a scenario where the Fed can delicately cut rates to support a gently cooling labor market without reigniting the fires of inflation. The risk is that this narrative is wrong. The risk is that the economy is actually experiencing persistent inflationary growth, and the Fed is about to pour monetary fuel on that fire. The data released between now and September 17th will determine which of these narratives prevails. The market has placed its bet. Now it waits to see the cards. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description.